credit score. It's just a three-digit number, but it quietly controls some of the biggest financial decisions of your life. Whether you get approved for a mortgage, what interest rate you pay on a car loan, even whether a landlord lets you rent an apartment, it all comes back to this one number.
And here's what's wild. Most Americans don't fully understand how it works. So today, we're going to break the whole thing down in 5 minutes. What your credit score actually is, how it's calculated, and, most importantly, how to boost it fast.
Your credit score is a number between 300 and 850, and it's calculated using 5 key factors. Think of it like a pie chart. Each slice matters, but some slices are a lot bigger than others. The biggest slice, at 35%, is your payment history. This is simple. Do you pay your bills on time? Every on-time payment helps. Every missed or late payment hurts. And the more recent the miss, the more damage it does. Next up, at 30%, is your credit utilization. This is the percentage of your available credit that you're actually using. So if you have a credit card with a $10,000 limit and you've charged $3,000, your utilization is 30%. Lenders like to see this number below 30% and ideally below 10%. The lower, the better. Then we've got length of credit history at 15%. The longer you've had credit accounts open, the better. This is the average age of all your accounts. It shows lenders you have experience managing credit over time. Credit mix makes up 10%. This is about having different types of credit. Things like credit cards, a car loan, a mortgage, maybe a student loan. Lenders like to see that you can handle a variety of credit responsibly. And finally, new credit inquiries, the last 10%. Every time you apply for a new credit card or loan, the lender does what's called a hard inquiry on your credit report. Too many of these in a short period can signal risk, and it'll ding your score a little. So where do you fall on the scale? Here's the general breakdown. A score between 300 and 579 is considered poor. 580 to 669 is fair. 670 to 739 is good. And this is where most Americans land. 740 to 799 is very good. And 800 to 850? That's excellent. You're basically the valedictorian of borrowing money. The higher your score, the better your interest rates, the better your loan terms, and the more options you have. Even a 50-point jump can save you thousands of dollars over the life of a loan. All right, so now the part you've been waiting for. How do you actually raise your score? Tip number 1. Pay every bill on time every single month. Set up autopay if you have to. Payment history is the single biggest factor, so this alone will move the needle more than anything else. Tip number 2. Lower your credit utilization. If your cards are close to maxed out, pay them down aggressively. A quick hack? You can also ask your credit card company for a credit limit increase. If they raise your limit but your balance stays the same, your utilization drops instantly. Tip number 3. Don't close old credit cards. I know it's tempting. You've got that old card you never use sitting in a drawer. But closing it shortens your average credit history and reduces your total available credit, which raises your utilization. Just keep it open. Maybe put a small recurring charge on it, like a streaming subscription, and set it to autopay. Tip number 4. Become an authorized user on someone else's account. If you have a parent, partner, or trusted friend with a long, clean credit history, ask them to add you as an authorized user on one of their credit cards. You don't even have to use the card. Their positive history gets added to your credit report. And tip number 5, check your credit reports for errors. You'd be surprised how common mistakes are. Wrong balances, accounts that aren't yours, payments incorrectly marked as late. Go to annualcreditreport.com, pull your reports from all 3 bureaus, and dispute anything that looks wrong.
Fixing errors can give your score an immediate bump. Now let's bust a few myths that trip people up all the time. Myth number 1. Checking your own credit score hurts it. Nope. When you check your own score, that's a soft inquiry. It has zero effect. Check it as often as you want.
Myth number 2. Closing a credit card improves your score.
Actually, the opposite is often true. Like we just talked about, closing a card can raise your utilization ratio and shorten your credit history. Both of those hurt your score.
And myth number 3.
You need to carry a balance to build credit. This is one of the most persistent myths out there, and it is completely false. You do not need to pay interest to build a good credit score. Pay your statement balance in full every month. That's how you build credit and keep your money.
And that's it.
Credit scores explained in 5 minutes. Remember, pay on time, keep your utilization low, keep old accounts open, and check your reports for errors. Do those things consistently, and your score will climb. If this was helpful, hit that like button and subscribe for more videos that make money stuff simple. And drop a comment. What's one credit tip you wish you'd learned sooner? I'll see you in the next one.